This morning, I made $10,355.41 in 32 minutes of day trading a low-priced biotech stock that had breaking news. No, my results are not typical, but in this episode, I'm going to break down for you the list of what I look for in these stocks, and we're going to start with number one, price. Let's jump onto the screen share so I can show you the chart of the stock I traded this morning. All right, we'll start by getting oriented here. You can see this is my P&L in the top corner. That's how I finished the morning. So I'm done trading, not going to take any more trades. And this is my trading layout. I'll go through each of these screens in a little bit more detail, but we're going to start by just looking at the price of the stock. So the stock that I trade today, yesterday closed at about 85 cents a share. And if you look at yesterday's chart, there was nothing going on. I mean, this thing was sideways. It had no volume. In fact, today it has 37 million shares of volume. In total yesterday, it probably had less than 500,000 shares. So how does the stock go from having 500,000 shares one day to 37 million the next? It's breaking news, which we'll talk about in a moment. But the thing that's important here, first of all, is that this stock fit within my price range of being something that I would be interested in trading. So this is the first data point that I look at, the price of the stock. And in this case, when the stock first came to my attention, it was at $1.45, slightly below my $2 minimum threshold. Now, I say that I like to trade low price stocks, but I usually don't like trading literal penny stocks. I don't like trading stocks below $1, and even stocks below $2. I find that that's not where I make the most money. Now, I will occasionally trade them. This is a rule of thumb. It's not a hard set, strict rule. So under $2 is okay, but I really prefer between 2 and 20. And in fact, my metrics tell me that I make the most money on stocks between 5 and 10. That's really my sweet spot. But just because that's my sweet spot doesn't mean I won't find some success just a little bit on the outskirts of that range. So in any case, today, the price of the stock was $1.45 when it first hit my scanner. That's the first criteria that I look for. I'll show you the scanner real quick just so you can get a sense of what that looks like. So this morning, I sat down at about 7:45 and I was ready to trade. I was like, all right, game time. It's sort of early in the morning. And I sit down early enough because stocks usually come out with breaking news around the top and the bottom of the hour. I have a window during the day when I make the most money. It's between 8 a.m. and 10 a.m. Before 8 a.m., I do make some money, but not as much. Most retail brokers, like the commission-free brokers, don't even allow people to start day trading before 7 a.m. So 7 a.m., anything earlier than that's like not really worth it. So at the earliest, maybe you could show up at 6:45 if you really wanted to be like an early bird, and that'd be fine. You may see stocks with breaking news from earlier right at 7 a.m. start to get volume as retail traders are able to start trading them. So then 7 a.m., 7:30, a lot of times news comes out at the top and the bottom of the hour. So 7, 7:30, 8, 8:39. And as the case was today at 8:30, ABVC, this biotech company, has news that comes out, and this is the headline: entering a license agreement to license rights to this other company with the indication of MDD and ADHD to this biopharma at the valuation of $667 million. So I do not spend my time studying the fundamentals of these companies, but when I see a stock hitting my scanner, it hit at $1.45, and then I see that it has news. What I recognize is that the market is responding favorably to that news, and that's really all that I need to know because I'm a technical trader. I'm not an investor. I'm a trader. I'm looking to trade the price action. So we have news, we've got volatility, we've got action. It's time to look for a trade. All right, so the stock hits $1.45. Now let's look at the whiteboard here. Our next requirement is that I'd like to see the relative volume is at least 5 times. This is a calculation of the average volume today relative to what's normal. So what is normal for this stock over the last 14 days versus what we have today? And in the case of ABVC, we hit at a relative volume on the daily of 172. So our actual was 172 times. Minimum was 5 times. We hit it 172. All right, so that one is A+. That's awesome. That's really, really good. I need number 3, the stock to be up a minimum of 10% already on the day. We look at the stock and it was already up 70%. This is the percentage change on the day right here. So I can actually pop this out to make it a little bit easier to read. So we'll scroll back. So ABVC, when it first hits, it's at $1.45. That's the price, $1.45. And we've got relative volume of 172, and we have 70% up already on the day. So this thing was moving. Number 3, do we have news? I want to see that the stock has news. The answer in this case was yes. Number 4. Number 5, float. Float of under 20 million shares. This one had a float of 2.41 million shares, as you can see right here. So when it first hits the scanner, this was at $1.45 at about 8.31, 8.32. You can see how quickly the stock moved up. The way this scanner works is that it's searching the market in real time for stocks that are moving. So this stock is squeezing up. It's hitting first at $1.47. And then as it continues moving higher, it hits the scanner again and again and again and again. Each time the data is updating, as you can see. The price is going up, the volume is increasing, price is going higher, volume's going higher, the percentage change on the day is going higher, the relative volume is increasing a little bit. So now it's moving up, and now right here, it jacks up big time. So price, volume increases, price goes up, relative volume is now skyrocketing, percentage change on the day is going up even higher. And from there, it just keeps going. All right, so this is laying kind of the groundwork for this was the right type of stock to trade for my strategy. I am a day trader, and I'm a momentum day trader specifically. So what I'm focusing on is not trying to predict the next stock that's going to make a big move. That's, I found, almost impossible. Unless you're a senator, a congressman, or you have friends who are CEOs of big companies, you don't know what's coming. We're just guessing. You and I as retail traders, we're never going to have an edge against the people that are on Wall Street that actually, know what's going on behind the scenes. So trying to be an investor, that's not realistic in my opinion. Unless you're just doing dividend investing, you're going to buy shares of Pepsi and hold it for 10 years. But if you're actually going to try to pick what's going to move in the next couple months, that's very difficult. So instead, I focus on being a trader. My goal is to generate relatively consistent profit pretty much every single day. So in order for me to do that, I need to find stocks that are volatile, that are moving, that have some type of catalyst. And today, ABVC, as it hit the scanners, clearly met that criteria. So now the next question is, all right, where do I buy it? Where do I sell it? How do I capitalize on this opportunity? Clearly, we have a stock that's volatile. So I'm going to zoom in here on my 10-second chart. So this is a 10-second chart. This is a very fast time frame. And we're going to look at the price action of this stock going all the way back here from when it first started squeezing up. All right, so it first pops up right here, as you can see, at 8:30. And this is your classic algo spike. It's a high-frequency trading algorithm that is designed to execute buy orders as soon as they see the news wire, the PR hit that this stock has a news catalyst. These are algorithms that are very sophisticated. They execute orders instantaneously, and we're never going to be ahead of them. However, these can be kind of like a big ship going through the harbor. They send out a wake. So we recognize, okay, this stock is triggering, it's firing, it's moving up. Now, all the little fish out there, you and me, we see that there's an opportunity. And so as this starts to pull back, now we get more volume as more traders recognize opportunity to get in. It pulls back a little bit. You get a little profit taking, and then you've got another wave up. More traders are coming in. And notice the volume is generally increasing. That's exactly what we want to see. So it pulls back a little bit here and goes up to $1.80, $1.90. And this right here, see how it hit $2? Right there was $2. I'll zoom in. That was $2. And then it pulls back right here. And that was where I took my first trade. So I bought this dip right here. And in this green candle, we got that first break of $2 a share. That is called a micro pullback. So with a micro pullback, what we're looking for, and I'll just draw this a little bit cleaner. So the stock squeezes up in this first candle, then it pulls back just for a moment. It doesn't even give a proper pullback. It pulls back just for a moment. And then what happens? The next round of buyers are already coming in. So when a stock is moving quickly, we get these micro pullbacks. They don't even give a proper pullback because traders are so eager to get a piece of the action. Now, right now, we're in a cycle where these penny stocks, especially the biotech pharmaceutical stocks, are super hot. They're getting a lot of attention. So it pulls back for a second, and there's traders ready to buy up that dip for the next leg higher. So you could think of this as a scalp trading strategy where you're buying, if we look at this right here, you're buying based on a dip. So there's two ways to scalp. One is to buy dips. So you buy this little dip right here. As this dips down, you buy down here with a stop really just like 5 or 6 cents below your entry. So it's a very tight stop. And then as soon as it pops back up, you're looking for it to break through the new high of day. And then right up into here, you can do one of two things. You could take profit and pay yourself, which makes it an official scalp trade because it's very quick. Or you can do something a little bit more aggressive. You can add to the position, and that's exactly what I did. I was like, I'm going to add to this. Let's see this thing. We're at the very beginning of the move. This is the time to add. Now, I don't want to add and be really aggressive when the stock, is, let's say, all the way up here. That's not the time to be as aggressive. The time to be aggressive is down at the beginning of the move. So it's the beginning of the move right in here, and I go ahead and I add. We get a pop, as you can see right here, up to about 225. It pulls back, and then right in here, look at how well this dip got bought up. The dip got bought up, and it sends it right back up to the new high, up towards 240. It pulls back, and what happens? That dip gets bought up too, and this sends it up to 250, all the way up to $3 a share. And right in that candle, I'm locking up $5, $6, $7, $8,000. I'm already up almost $10,000 on the day. So if the first scalp trading strategy on this is to buy a dip, the second is to take a breakout. So a breakout trade is when, rather than buying while it's pulling back, while perhaps you're even seeing red on the tape, you're waiting first to see those green orders going through the time and sales. So you want to see green on the tape. What does green on the tape look like? I'll show you right here real quickly. So if we pull up this stock just for example, so the ABVC from today, right now we're seeing some green on the tape right there. That's green on the tape. Perfect timing. All right, so that's what we want to see. That when you see that, and you see that when the stock is just below a breakout point. So let's just say, for example, let's get dialed in here. So let's say right in here, this would have been a dip trade if you bought right here. If you bought right here, that is a breakout trade because you're buying right below the high of day and looking for that squeeze through the high. And naturally, because you're in a little higher, you've got to set, you don't want to set your stop way down here. That's too far away. So you end up setting a little bit of a tighter stop, and you got to take profit fairly quickly. And that's fine. Scalp trading there's nothing wrong with scalp trading. You just have to be quick. And I suppose most importantly, if you're going to try to scalp trade these, you have to be able to cut your losses very quickly. Because most scalp traders have relatively small winners. And so a couple of big losers can throw off the profit loss ratio. But there's a lot of different ways to trade this. Scalp trading is just one way. I saw a number of traders who said that they got in around $2 and they said, I'm going to hold this and see if it goes to 250 or 3. Now that's certainly not a scalp trade. That's when you're doing a bit of a momentum trend trade. You're getting in and you're saying, I'm going to hold this and mentally use a trailing stop. So when I first get in at 2, I'm setting my stop at 190. And then when it goes up to 220, I'm setting my new stop to 199. It goes up to 230, I'm setting my stop to 215. Mental stop, right? It doesn't have to be a live stop order. It could be a mental stop. When it goes up to 280 here, maybe this is where you take a little profit off the table and move the stop on the rest of it to 250. And that's fine. And you might say, gosh, not only is it fine, that looks brilliant. Why don't you always do that? And the only reason I would say you don't always do that is because of candles like this guy right here. Because those can wipe out all of that profit so quickly that if you don't take profit when you have it, gone. They can disappear very fast. So what ended up happening on this stock is we hit a high a day. We had this kind of dramatic sell-off. It bounces all the way back up, sells off again, comes back up again, sells off again. So now, excuse me, now we're starting to get a bit of choppiness and we're starting to consolidate. I, at that time, drew this ascending support trend line connecting the low of about that dot there, that low there, with something like right around here. I also drew this descending resistance line connecting these two dots, and I drew a line at the high of day. And now what I noticed was the stock seemed to be holding this support level until right here when it broke. It breaks that level and then it tries to get back up above it and it can't. It sells off. Tries again and it can. It sells off. So it felt like this blue line was being pretty well respected. It tries again right here, but it can't hold it and immediately rejects back below. So look at these lines that I drew. I drew these lines, right here. And look at how well they help me understand the price action moving forward. So now I'm like, it's a little bit too risky. We're below it. But right here, we bust through that level. And so my last trade was I let it break through this level. I let it pull back. And this is a micro pullback right there for an entry at about 369. And that gave us a move here up only to about 385. But nonetheless, it was still a small trade, a small winner. We got a little bit of a pullback back down to 360, came back up one more time, but it wasn't able to break over 4 and continue. And at that point, we sort of had the formation of the head on the head and shoulder. We got back below this blue line. We couldn't get back above it. And that's when I kind of thought, all right, I think we're going to be selling off here. Bear flag there at the open. We sell off more. And that's the other arm on the head and shoulders pattern. So the fact on this is the time to trade it was the front side of the move, which, really was all in here. And sometimes it can be hard to know if, the move is over right here. And so I just waited for it to prove itself. And then this was where I took trades. I wasn't trading it in this area here, even though I could have. I felt that there was too much upside resistance. And so I said, no, I'm going to wait for this to really prove itself. If it's strong, it could go all the way up to 5 or higher. However, there was something that was holding this one back, and that was on the daily chart. So on the daily chart, we had this magenta line, as you can see here, which is our 200 exponential moving average. That is a very strong psychological level of resistance, and that was at about 479. So given that it was below that level and I knew it would have resistance when it came up to it, I did think that we had max upside potential most likely of about 479. So once we got up to about 380, 390, I knew we were getting a little close to that level. In terms of risk management on this trade, on my first trade at the beginning of the move, I took my first trade, got my profit, and then I started increasing share size. So if you looked at my aggressiveness, it would look like this. Increasing and then decreasing like that. So I was the most aggressive. I was the most aggressive in this area here. And then I was much more conservative on those final trades as it got higher because I didn't want to give back the profit that I had already made. It's important to be able to be, on the one hand, aggressive on the front side of the move, but also play a little defense and make sure you don't give back too much of your profit. So this strategy right here, this is the definition of momentum trading. Now, whether or not this stock closes the day at $5 or it closes the day at $2, it doesn't really matter at the end of the day because active traders found a window. We had a window of opportunity, and that was really in the first 30 minutes, the first 32 minutes to be exact, and that was the time to be the most aggressive. And now, hands are off the keyboard until either another stock has breaking news in the middle of the day, or more likely, tomorrow morning, I come back and do the same thing again. You can see these are my metrics trading this strategy, just under $12.5 million in gross profit. And if we look at the overview of even just the last few weeks, you can see consistently green, focusing on trading at the open, being aggressive, and not overstaying my welcome. The idea of this strategy is to get in, get green, and get out. Consistency is where it's at. Because for me, my goal is to try to generate consistent profit as a trader. I'm not trying to swing for home runs and hit an occasional big winner. I want to lock up a little bit of profit every single day. And that can start with as little as $20 every day. And then it goes to 30, to 40, to 50, to 100, to 200. Now you're making 50,000 a year. Then to 400, you're making 100,000 a year. And it goes up from there. Now, if you want to learn a little bit more about trading, check out this episode I recently uploaded, or check out this one that YouTube thinks you guys just might love. And I'll see you for the next episode right here.